If you want my honest answer, the biggest threat to the American economy was never the loud thing on television. It was never artificial intelligence by itself. It was never China by itself. It was never the latest shouting match out of Washington. And it was certainly never just whichever politician happened to be sitting in the Oval Office. It was something much duller. And in finance, the dull things are often the things that matter most because nobody pays attention to them until the damage is already everywhere. The danger I want to talk about begins in Tokyo. More precisely, it begins in one of the most boring assets on earth, Japanese government bonds. That sentence will not excite the average investor. It should. I have spent a lifetime learning that markets are rarely broken first by the thing that creates the loudest debate. They are more often strained by something so dry, so mechanical, and so unglamorous that the public never thinks to study it at all. People enjoy attaching their fear to stories with bright colors: a technology bubble, a trade war, a charismatic politician, a dramatic company, a powerful central banker, but the system itself does not run on colorful stories. It runs on plumbing. And for more than 30 years, Japan has been one of the quietest and most important pieces of global financial plumbing in the world. Most Americans do not understand that because they were never taught to think this way. They were taught to think of Japan as a culture, a trading partner, a source of cars, electronics, anime, tourists, and perhaps a nation that somehow never fully recovered its old economic dynamism. They were not taught to think of Japan as one of the silent support beams underneath the cost of money across the globe. That is the real story. And if you understand it properly, a great many things that seem confusing in the American economy suddenly become much easier to explain. Why have mortgage rates remained stubbornly high, even when the Federal Reserve talks about cuts? Why do stock markets sometimes become nervous for no obvious headline reason? Why can Jerome Powell sound more dovish, while long-term borrowing costs still behave as though they do not fully believe him? Why does the economy sometimes feel tighter than the policy headlines suggest? The answer does not begin in Washington. It begins in Tokyo. To understand how we got here, you have to go back to the early 1900s. Because Japan lived through one of the great financial hangovers in modern history. There was a time when Japan looked almost unstoppable. Real estate soared, equities soared, confidence became cultural. The country had the sort of glow that makes intelligent people start saying irrational things in a calm voice. They began to believe that the old limits no longer applied. That is an old error in finance. Every great bubble creates a vocabulary of explanation for why the usual laws are now out of date. Japan had its own version, then the bubble burst, real estate collapsed, stocks collapsed. And what followed was not one dramatic year of pain that quickly washed out the excess. It was something stranger and, in many ways, more haunting. Japan entered what came to be known as the lost decades. I do not use that phrase lightly. It was not merely a recession. It was a long, grinding era of weak growth, weak inflation, weak wage expansion, damaged animal spirits, and a population that slowly learned what it feels like when an economy never fully recovers the old rhythm of confidence. The body of the country kept moving, but a great deal of its economic metabolism seemed to stall. That is the sort of environment that pushes central banks into experimentation. When ordinary policy tools stop working, central bankers begin doing things that sound technical and temporary while quietly changing the structure of the whole financial world. The Bank of Japan cut rates, then it cut them lower, then it held them down. Then, when even that did not feel sufficient, it moved into even more unusual territory and introduced yield curve control. That sounds like something designed by a committee trying to make intervention look scientific. In plain language, it meant the Bank of Japan decided it would not merely influence short-term rates. It would also suppress long-term government bond yields by force, if necessary. If markets wanted to push them higher, the bank would stand in the way. And so, over time, Japanese government bonds became the very picture of dullness. They paid almost nothing. They offered almost no return. They became a vast domestic pool of near-sterile savings instruments in a country where institutions still needed yield whether the local market wanted to provide it or not. That is where the global consequences began. Imagine you are a Japanese life insurer. You have obligations that continue for decades. Imagine you are a pension fund. You owe future payments. Imagine you are a bank, a trust, a large asset manager, or a wealthy household trying to preserve and grow capital, and your domestic government bond market yields essentially zero. You still need return. Your liabilities did not disappear simply because the home market became numb. That leaves you with a very simple problem, and eventually a very simple solution. you go shopping elsewhere. This is how Japan became one of the most important foreign sources of demand for assets all over the world. Japanese institutions bought us treasuries, mortgage-backed securities, foreign bonds, and all kinds of other instruments that yielded more than the sterile assets at home. Over time, Japan became the world's largest net creditor nation, which is a formal way of saying it was lending the world enormous amounts of money, and that capital mattered far more than the public realized. It was not merely money moving from one nation to another. It was the creation of a global funding structure for years. An enormous amount of global liquidity depended on one quiet truth. Money in Japan was unusually cheap. That cheapness did not remain politely trapped inside Japan. It flowed outward and shaped global markets. This is where the yen carry trade enters the story. The phrase sounds boring enough to make most people tune out immediately. That is a mistake, because the yen carry trade was one of the great hidden engines of global liquidity for a very long time. The mechanics were not mystical: borrow in yen at near zero, convert into dollars or other currencies, buy something that yields more, keep the spread. That is the whole game. It was the sort of trade that begins as an elegant arithmetic opportunity, and then, because the arithmetic remains favorable for so long, gradually becomes part of the financial climate itself. The climate changes before the public notices the weather pattern that caused it. To understand how important this became, picture a very ordinary investor. Call him Kenji if you like. Kenji does not need to be reckless. He does not even need to be brilliant. He only needs access to very cheap yen funding and a world full of assets that yield more than the cost of that funding. He borrows in yen at what feels like almost nothing, converts into dollars, buys us treasuries, hedges part of the currency exposure, and earns the spread. Now multiply Kenji by banks, insurers, pensions, macro funds, large institutions, corporate treasuries, and a global ecosystem of capital that learns to treat near zero yen funding as part of the normal background of finance. That is what happened. And once cheap funding exists, it does not stop at treasuries. It reaches for whatever yields more and still feels acceptable. Mortgage securities, corporate credit, growth stocks, real estate-related assets, emerging market debt. A great many things were directly or indirectly helped by the fact that one of the world's great pools of savings lived inside a system where the local cost of money was artificially and persistently low. This matters because cheap funding changes behavior everywhere. It does not only lower bond yields, it increases risk appetite, it lowers discount rates, it makes longer duration assets look more attractive, it helps support the prices of things whose value depends heavily on a low cost of capital. For a long time, global markets functioned as though Japan would keep playing this role forever. That was the hidden assumption. Japanese yields would stay pinned near the floor. Borrowing in yen would stay cheap. The carry trade would remain attractive. Capital would continue flowing outward. The United States, among others, could keep benefiting from one of the world's most consistent sources of foreign demand. That assumption held long enough that people stopped treating it as an assumption. That is always when danger begins, because once the market forgets that it is living on an assumption, any change in that assumption feels like a shock rather than a reversion to reality. Then, in 2024, the regime changed. The Bank of Japan moved away from yield curve control. It raised rates, then it raised them again. Not in the theatrical way people associate with aggressive tightening cycles, but enough to make something very important happen. The floor was no longer permanent. The old math began to change. And when that happened, markets reacted sharply enough to remind anyone paying attention that this was not merely a local Japanese policy adjustment. Japanese equities suffered a violent repricing. American equities stumbled as well. The message was clear enough for anyone not blinded by television noise. The world had become dependent on a source of cheap funding that was no longer quite so cheap. Now let us be very precise about why that matters. When Japanese yields rise, the carry trade becomes less attractive for two reasons at once. First, the borrowing cost in yen rises. Second, the cost of hedging the currency exposure can rise as well. That means the lovely easy spread between near zero funding and higher yielding foreign assets begins narrowing. And when a spread narrows enough, the trade stops looking like free money and starts looking like work. That is when capital begins reconsidering where it wants to live. This is the beginning of repatriation. Money that once flowed outward begins moving back home. And when the home market finally offers something again, domestic institutions do not need to be such aggressive foreign buyers. This is where the American bond market enters the danger zone. For decades, Japan was not just another buyer of U.S. Treasuries. It was one of the great reliable, price-insensitive buyers. That phrase matters. Price-insensitive buyers stabilize markets because they are not constantly negotiating with every wiggle in yield. They have structural reasons to buy. When a structural buyer steps back, even slightly, the market has to find a new clearing level to attract someone else. That usually means higher yields, and here's where the public conversation becomes childish. People act as though the Federal Reserve controls all interest rates. It does not. It controls the short end most directly. It can set the overnight rate. It can shape expectations. It can provide liquidity. It can influence the tone of policy. But the long end of the Treasury curve lives in a different world. The 10-year, the 20-year, the 30-year are fundamentally influenced by supply and demand. How much debt is being issued? Who is buying it? At what inflation expectations? Under what risk preferences? With what alternatives available elsewhere? That is why long-term yields can remain elevated even while the Fed is cutting short-term rates. This is one of the most important things the average American still does not understand. He sees the policy rate come down and assumes mortgage rates must soon follow obediently lower. He assumes financial conditions will automatically ease. He assumes the machine is simple. It is not. If the U.S. government keeps issuing vast quantities of debt, and one of its most important foreign buyers becomes less enthusiastic, the long end of the market can remain under pressure regardless of the comforting headlines. This is what the bond market has been trying to say. And the bond market, though boring, is still the backbone of everything else. That phrase is not rhetorical. The long end of the Treasury market influences the discount rate for equities. It influences mortgage rates. It influences corporate borrowing costs. It influences real estate capitalization rates. It influences the cost of refinancing for the private sector. It influences how rich or cheap every future stream of cash looks when brought back to the present. That is why, when the long end stays elevated, the whole financial system feels heavier. Take housing. Mortgage rates are not simply a political talking point or a behavioral preference. They are anchored to long-term yields plus spreads. If the 10-year Treasury refuses to fall meaningfully, mortgage rates will not magically return to the sweet, comfortable levels. People remember from the easy money era. That has enormous consequences. Housing affordability remains strained. Refinancing stays subdued. Transactions slow. Homeowners remain locked in. The whole market gets sticky and less fluid. People often interpret this as a puzzle. It is not a puzzle. It is arithmetic. If long rates stay high, the price of long-dated household debt stays high. That slows housing. Now move from housing to equities. When analysts build valuation models, they may dress it up with beautiful terminology, but underneath the language they are discounting future cash flows. Raise the base discount rate and the present value of those future cash flows falls. That is especially true for long-duration assets. The very companies whose valuation depends heavily on expectations far into the future. This is why growth stocks can become so unstable in a world where long rates stay high. The businesses themselves may still be good, earnings may still be growing, but investors are willing to pay less for distant future money when they can earn more in safer, nearer-term instruments. That is not irrational. It is how discounting works. Then there is corporate credit. When capital was unusually cheap, companies could refinance easily. Private equity could borrow aggressively. Risky projects could be justified, and financial engineering could mask a lot of mediocrity. When long-term rates remain elevated, all of that becomes more difficult. Borrowing costs rise, deal activity slows, weak business models become more exposed, the bloodstream of corporate finance becomes less forgiving. And because so many businesses and valuations were built in an era where cheap money felt normal, even a partial reversal matters more than the public expects. That is the environment we are moving through. And I do not think most people are emotionally prepared for it because they are still looking at the wrong story. They want the story to be about Powell because Powell is visible. They want the story to be about politics because politics is loud. They want the story to be about AI because AI is exciting. Fine, let them have their entertainment. I want the plumbing. I want the funding source. I want to know which hidden beam the whole structure has been leaning on. Japan was one of those beams. If that beam weakens, even modestly, the effects do not stay neatly inside currency strategy discussions. They move through the whole system. This is why I never trust surface calm in markets. Calm on the surface may simply mean most people have not yet traced the mechanics down to their actual source. I think often about the difference between a headline and a mechanism. A headline is what the public argues about. A mechanism is what actually changes price. Most investors spend their lives attached to headlines. A smaller number learn to care about mechanisms. That smaller number usually has a much better chance of surviving the next decade with their dignity and their capital intact. I have always preferred mechanism. Mechanism explains why mortgage rates stay elevated when the political narrative says they should fall. Mechanism explains why the bond market can resist the Fed. Mechanism explains why a major foreign buyer matters. Mechanism explains why long-term rates can keep the economy feeling tight. Mechanism explains why a shift in Tokyo can affect a family in Texas trying to buy a home. Mechanism explains why equity multiples can feel unstable, even without a dramatic recession. Mechanism explains why the cost of money is not one thing. Now, I do not say all this to imply that Japan alone determines the future. That would be foolish. The U.S. economy is vast. American institutions still buy treasuries. Domestic pensions matter, banks matter, insurers matter, households matter, Federal Reserve policy matters, inflation expectations matter, fiscal policy matters. Nothing in finance has one father. But marginal buyers matter disproportionately in debt markets. And Japan has been one of the most important marginal buyers in the world for a very long time. A market drowning in supply feels the loss of a marginal buyer immediately, even if the public needs months or years to understand what changed. That is where we are. The cheapest source of global funding is no longer as cheap. The assumption of endless Japanese support is no longer quite as safe. The carry trade is less automatic. The capital that flowed outward for decades has more reason to hesitate. And because the United States is issuing enormous quantities of debt, hesitation at the margin becomes a force. That is why I keep returning to a sentence most people still do not say aloud often enough. Long-term yields matter more than the public thinks. They matter because they are not merely numbers on a screen for bond specialists. They are the price of time in the economy. They sit underneath housing, business, private equity, infrastructure valuation, growth equity valuation, and the whole architecture of financial risk-taking. When the price of time rises, the future itself gets repriced. That is what the market is doing now. I have spent my whole career mistrusting easy narratives. Whenever the crowd wants the story to be too simple, I assume the truth is sitting somewhere more boring and more important. And the truth here is that America spent decades benefiting from the world. As biggest quiet carry trade, cheap Japanese money helps support our bond market, our mortgage market, and our broad financial conditions in ways the average voter never had any reason to study. Now that regime is shifting, not ending overnight. Shifting, that is enough. A great many market events do not require a total reversal to matter. They only require the margin to move enough that the old assumptions stop working as smoothly as they used to. That is what we are seeing. The old comfort that someone somewhere will always show up and buy the debt without complaint is becoming less reliable. The old comfort that lower Fed rates automatically mean easier long-term financing is becoming less reliable. The old comfort that global liquidity is a natural condition rather than a policy-dependent one is becoming less reliable. I prefer not to romanticize any of that. I prefer to adapt. If you understand this story, then you stop making simple-minded forecasts. You stop saying the Fed will cut. Therefore, mortgage rates must collapse. You stop saying bonds are boring and therefore unimportant. You stop saying Japan is a local Japanese story. You start asking different questions. Who is the marginal buyer now? What yield attracts enough demand? How much debt still needs to be absorbed? What does that do to housing? What does that do to stock multiples? What does that do to refinancing risk? What does that do to corporate confidence? These are adult questions, and I have always believed adulthood in finance begins when you stop outsourcing your understanding to whatever happens to be loudest. So if you want the shortest version of what I am saying, it is this. For 30 years, Japan quietly helped make money cheap for the rest of the world. That cheapness spilled into treasuries, mortgages, equities, and credit. Now Japanese yields are rising. The carry trade is less attractive. Capital has more reason to stay home. And the American economy must confront what things look like when one of its most important silent supporters becomes less generous. That is not a headline story. It is a structural story. And structural stories are the ones that last. That is why, if you ask me what really matters here, I would not tell you to watch the loudest fear. I would tell you to watch the quiet funding source. Because in the end, it is not the shouting on television that determines the price of money. It is the buyer on the other side of the trade for a very long time. Japan was one of the most important buyers in the world. Now it is reconsidering. And when a buyer like that reconsiders, the whole world has to rethink what easy money was actually built on.